Now, for a reaction to the Dallas Fed president's comments, let's bring in Mark Olson, a former Federal Reserve governor appointed by President George W. Bush. He's now co-chairman of Treliant Risk Advisors. He joins me now from our Washington bureau. Mr. Olson, welcome to Bottom Line. Thanks for coming on today.
Thank you for the invite. Pleased to be here.
Sir, in his introductory remarks, Richard Fisher said the FOMC's policy as it relates to the current economic environment, in his words, has yet to show evidence of working. And it seems that nobody quite understands why. Do you?
I would say it's slightly different, and I would go back and quote what some of the other people who voted for it have said. It is not a panacea. It was never the expectation that it would make a dramatic difference. It was simply one more weapon that the Fed had to try to stimulate the economy, and it would help on the margin, but only on the margin. I would have voted for it. I support it because, in my mind, there's little downside risk in doing so.
Oh, sir, the latest version of Operation Twist seeks the same results as its first incarnation. That's when President Kennedy announced it shortly after he took office in 1961 to increase investment and create jobs. Is this version enough to achieve those goals, or is the macro environment so bad that this is just a short-term solution to a long-term problem?
The best macro analysis that I've seen, and of course you can't, and as Richard Fisher suggested, you can't analyze human behavior, so we'll never know what the reaction will be. But a macro analysis would suggest a slight improvement in the economy and perhaps as many as 350,000 jobs over a 2-year period. Now, that is a drop in the bucket relative to what we need. So I think even the most optimistic supporters see this as a very marginal improvement.
Mr. Olson, is the dissension among the FOMC members, is that a cause for concern, or is it just an indication of thoughtful deliberations by people who, according to Mr. Fisher, have been working in the harshest economic environment?
I think it is primarily a function of the environment. The last time I saw this much dissension, relatively open dissension, among the board members was back in the 1979 and 80 era, when Paul Volcker was trying to get a majority just of the board itself, not the full FOMC, just the board, to try to change direction with respect to the manner in which they conducted monetary policy. And so I think it is significantly a function of the fact that we are in difficult times and there are no easy solutions.
Ben Bernanke has said on more than one occasion that the Fed can only do so much, that members of Congress have to do their part to get this economy moving. In your opinion, where have Congress and the White House failed to implement policies and strategies that would give life to the economy and put Americans back to work?
Well, the most obvious was the way they dithered on increasing the debt ceiling, something that should have been automatic. The money had been already spent. It's a little bit like deciding after you've already spent money and you get your credit card bill that you're now not going to honor it. It was a disingenuous thing for the federal government to do, particularly the Congress. And I think that as people looked at it, they said if they can't even do that relatively simple task, how in the world can they take on some other measures, such as something that would be fundamentally stimulating? And so I think that's where they went wrong.
Mr. Olson, did that action, in your view, hurt our standing and our credibility around the world?
It significantly hurt our credibility because I think it demonstrated that we were willing to put to go into financial default, not because we did not have the capacity to meet our financial needs, but over a political difference. And if I were outside the U.S. and I was looking at U.S. financial credibility, I would say indeed it has been significantly strained.
You're a former banker, a former president of the American Bankers Association, former staff director for the Senate Banking and Housing Committees. Jamie Dimon, the CEO of J.P. Morgan Chase, told the Financial Times this month the United States should consider withdrawing from the Basel Group of global regulators. He called the new international capital rules, quote, anti-American. Is he right? Are the rules in the best interest of the United States? And should the U.S. withdraw from Basel?
Well, let me take that two ways. It's critical that there not be a difference between the European rules and the U.S. rules.
Why do you say that?
If you do that, you get if you do that, you get what we call regulatory arbitrage, where banks will look to try to do business in the environment where they have the loosest regulation, or in this case, capital standards. That said, I think it is absolutely critical that we do have international agreement on capital standards. If we go back to the mid-50s, the last time we did not have international agreement on capital standards or the components of capital, some of the banks that were operating in other parts of the world that were operating under a completely different regulatory regime caused a lot of financial hardship around the world. And I think that we need to make sure that we are working together. So I would hate to see the U.S. Try to move unilaterally. But on the other hand, it's very important that the international regulators not isolate the U.S. in a competitively disadvantaged position.
Mark Olson, the former Federal Reserve Governor, now chairman of Reliant Risk Advisors, joining us from Washington. Mr. Olson, this has been very enlightening. I hope we can have you back on again soon.
Look forward to it. Thank you.
Thank you, sir.